Good morning, ladies. I hope you're all well. We're going to look at the next PowerPoint in making markets work, which basically is the theme 4. So we're talking about chapter 6, which basically is market failure. Now, we have talked about market failure before, and that, generally speaking, is where we've got situations where maybe the free market isn't allocating resources in quite the right way, and maybe we're not achieving productive or allocative efficiency for some reason. So first things first, so that you've got this in your locker that you can use, just think about 3 real-world examples and explain the term market failure. Give 3 examples, or have 3 examples that you can reference should you need to demonstrate an understanding of that as far as that is concerned. And obviously, if you can demonstrate that with a diagram, and you'll see how that's feasible to do in a couple of slides' time, then clearly you can also use a diagram to support that and evidence the fact that you completely understand the principle. So in this topic, we're going to be looking at a number of things. We're going to look at the significance of market power. So where you have dominant competitors, or maybe you've got an imperfect market where it's either oligopolistic or duopolistic or even monopolistic. The significance of market power is something that we'll need to consider. We'll look at things like cartels, collusion, restrictive practices, and tacit agreement tend to be where we're talking about oligopolistic markets, and these are all examples of how organisations might choose to use their, and maybe in some cases abuse their market power, and actually in some cases not necessarily have the best interests of consumers and them maximising their utility at the heart of what they're doing. We'll also look at monopsony power. It's something that we have looked at briefly when we were looking at labour markets, and that's where you've got one buyer of services in a particular scenario. But again, we'll come back to that and look at that in a bit more detail shortly. We'll also look at natural monopolies, and also the power, the relative, where the power balance lies in the labour market. Is it with one major employer, or can trade unions also affect that? So these are all to do with different types of market failure, and what is feasible to do to address that. Now, clearly, one of the other things we're going to look at are the implications of market failure in the business world for economic agents and governments. Okay, so clearly we're reliant on, if we're talking about allowing the market to decide how resources are going to be allocated, we have to rely on that market to do it in a just, fair and efficient way. And unfortunately, in certain scenarios, that doesn't happen, and that's what we're going to be looking at as far as market failure is concerned. So let's take a look at some of the issues. And this issue of market failure tends, in this case, to be where we've got imperfect market structures. Okay, so we've got levels of imperfect competition. So in terms of collusion, and some of you might have heard the term before, but that's essentially where, particularly in an oligopolistic market, firms agree to work together to some degree to benefit themselves, and in some cases maybe benefit from some elements of monopoly. So collusion is basically talking to one another, a big business is talking to one another and deciding how they might actually manage the market to suit their requirements, and that might well distort the allocation of resources in the favour of the oligopolistic power holders in the market. Okay, so clearly, in some cases, there is this principle that collusion is going to benefit those that are in oligopolistic markets, and in some cases, it allows them to operate in conditions even closer to the conditions of monopoly, where effectively you're setting a price and you're actually then possibly exploiting the position, the strong market position that you're in, to the detriment, in this case, of your customers, and also to some degree the allocation of resources. So in some instances, in terms of what we might do if we're in a position where we're colluding, we might choose to charge higher prices and gain higher sales revenue. Now that clearly would lead to a position where we would be trying to get to a profit maximization point. And again, most businesses, not all, but most businesses will probably have profit maximization fairly close to the top of their objective list. And remember, the point at which you would operate in a profit maximization market would be the point at which MC, marginal cost, equals marginal revenue. And up to that point where marginal revenue was actually higher than marginal cost, you would be achieving profit with each extra sale that you achieved. Now, firms will often collude to segment the market geographically. So, for instance, if we're talking about, it's not always segmented geographically, but there could be an agreement to say, well, we're not going to come on and work within a particular area if you've got a stronghold in that area. And obviously that's going to benefit the dominant market shareholder in that particular area. That obviously, in some cases, if that happens, that almost gives the firm monopoly power in that particular geographical area, because effectively they're agreeing not to compete with one another in those particular markets, and clearly that means that you are going to be in a dominant market position, and maybe you can then set prices and also decide what you're going to produce to suit you rather than suit the marketplace. So if we take a look at how we might show that graphically then, and this diagram shouldn't be a surprise to you, we've seen it before, but where we're talking about colluding, an oligopoly may well actually perform much more like a monopoly, so where monopolist firms can make supernormal profits, where essentially average revenue and our demand curve is actually, or our average revenue curve is significantly greater than the average cost curve. Now, in this scenario, remember we talked about as a profit maximizer, we would operate at where marginal revenue equals marginal cost. So at the point Q, as you can see here, well, you can see at this point, if we're talking about marginal revenue and marginal cost, well, clearly in this scenario, because we've got average revenue significantly higher than that, and at the point at which we could be pricing goods and services in a monopoly position at P, that is significantly higher than the point at which we would normally be operating. And that's because in this instance, the firms can get away, because there's sufficient demand at this point, they are going to then be setting prices at a point at which, the highest point at which they can achieve at that quantity, which is P. And in this instance, clearly, there is a significant difference between the average revenue line and the average cost curve. So in that instance, where we would be in a profit maximization point, because average cost being at this point here at quantity Q, and the price being significantly higher than our average cost at that point. Hence the profit maximization process, and also the ability to make supernormal profits. Now, one could argue that in a perfectly competitive market, which is essentially productively and allocatively efficient, most efficient, in that scenario, we would be pricing at a point where we would be achieving normal profits, where we would be simply achieving the revenue to match up with the average cost. Well, in this instance, that is a significant amount of extra revenue, and obviously in that case, because our costs are significantly lower, that's the point at which we're actually making significant amounts of profit. Okay, so let's move on. So if we then take a look at the different types of collusion, then we can have a number of different types of collusion. We can have overt and tacit collusion. Let's take a look at what those mean then. A cartel basically is a formal agreement between firms to collude in the operation of a market. Now, cartels in lots of parts of the world are actually illegal because they're not in the public interest. They're not in consumers' interest. What they are set up to do is for the firms, the big firms who are within that cartel, to actually benefit and exploit their market position. Normally, it takes a form of some form of price fixing, but it also might involve fixing output levels. So if you restrict the amount of output that you're producing, maybe that is also going to some degree increase the price that you might be able to charge. So effectively, again, when we talk about the principles of cartels, it is a form of collusion, and effectively what cartels allow is for member firms to operate more closely to the conditions of monopoly, like we discussed before. It's clearly not in the interest of consumers, and as we've mentioned previously, they're mostly deemed to be illegal. So if companies are found to be operating in cartels, they can get fined significant amounts of money by the authorities. In some instances, though, if you have overt collusion, in some cases it might be that cartels would come together, and if allowed, they might actually, the scale of their operations when they work together might be seen to be in the public interest. And if they are researching a new wonder drug or something that is going to be of benefit to a number of people, and a large part of the market, then in some cases this overt collusion can be seen as a good thing, provided it's in the public interest. Now, there are other things that are not quite as bad as overt or more, even worse, tacit collusion. You can, in some cases, achieve restrictive practices can happen where, in a situation that's not considered to be as bad a scenario as. Sorry, I'm just getting a phone call. It's not considered to be as bad a situation as collusion, but restrictive practices is where you might raise prices or restrict output, and that could, in some cases, refuse supplying stock to competitors, and some price discrimination, which is another thing that we looked at previously. So that is another form, a not so bad form of collusion, but again, certainly not considered to be in the public interest. Let's take a look at price leadership then as another principle. So very common in oligopolistic markets, where essentially the dominant firm will set the price and other firms will follow suit, normally over a period of time. And remember, when we talked about oligopoly, although you do on occasion, oligopolistic markets do occasionally get price wars, it doesn't happen very often because effectively the price war is going to damage all companies within a particular oligopolistic market, and as a result, it tends to mean that price wars tend not to happen too much in oligopolistic markets. So in this situation, though, if we're talking about the dominant firm, we might that process happening, then that's likely to cause higher prices and in some cases lower output. To some degree, the lower output is to create some scarcity value, which then allows higher prices to be charged. So in certain scenarios, and if you think about this as a principle, if we have this sort of thing going on, the whole market actually benefits in terms of higher revenues, but consumers are going to lose out. They are not going to be getting the maximum utility, or they might still be getting a significant amount of utility from the good or service, but it's costing them a significant amount more money to buy that, and as a result you could argue that the level of utility is falling as a result. Some price agreements may be explicit, where a firm overtly agrees to set a price. In some cases it might be implicit, where there's tacit agreement over prices, and these implicit or tacit agreements tend to be much more difficult for regulators to identify. It's probably not a contract drawn up, or it's probably a handshake or a nod and a wink, and there's no sort of paperwork trail to be able to follow. But in that case, obviously, it's much more difficult for regulators to try to address. Let's take a look then at the next thing. So we looked at oligopolistic markets, and let's take a look at how monopsony might also cause market failure or have an impact on the way in which scarce resources are allocated. So basically, monopsony is where you've got just one buyer in a particular market. So for a monopsonistic market, you've basically got one buyer of a particular factor of production or goods and services or whatever. Okay. Now, in that situation, a monopolist can set prices for its buyers, and the monopsonist can set prices that it pays to suppliers. Okay, so remember, the monopolist will set prices. They will be a price maker, but a monopsonist can actually set the price it pays to its suppliers, because they're the only game in town, so to speak. They're the only people buying in that particular market. So the monopsonist can use its buying power to influence the amount that it pays for its various different supply chains. Now, clearly, in this scenario, the price in certain markets is going to be heavily influenced by a monopsonist, and the price that's set at what the firm is willing to pay for a good or service. So the monopsonist, because it has this buying power, is able to influence a market, and clearly that's playing very much into its hands, and is creating benefit for the monopsonist. So if you have a monopsony power, have any level of monopsony power, that suggests that firms in the marketplace will face an upward sloping supply curve, unlike in perfectly competitive markets, because in this instance, if you've got that monopsony power, to some degree, you are going to be influencing both supply and demand of the particular good that you are buying. We also get, it's a difficult one to pronounce, it's oligopsony, and that's a term that's used when you just have a few buyers in the market. So monopsony is when you've got just the one buyer. Oligopsony is when you've got a few buyers in the market. And they, to some degree, are able to exert the same sort of monopsony power. Not to the same degree, clearly, because in some instances, there will be more than one person buying the particular good or service that we're talking about here. So if we take a look at how monopsony, or at what the effect monopsonists have on a market, this is basically how it all works. Now we'll just take this step by step and make sure it all makes sense. So we've got a situation here in the content that's provided in the blue panel, where we've got a perfectly competitive market that's in equilibrium at DS. Okay, so our perfectly competitive market is where we got P as the price, Q as the quantity, and the market is in equilibrium. Supply and demand are matched up. Okay, now if the monopsonist operated in this particular situation, they might be able to bargain a lower price, which would then move the market equilibrium price downwards. Okay, so in this instance, monopsonist might be buying just at Q1, and in this situation, that's going to cause the price to fall. Okay. So again, if we take a look at how that all works, then the MC curve, the marginal cost curve for the monopsonist, is steeper than the supply curve. And in this situation, not only do they have to offer a higher price for the marginal unit, but they also have to pay at the same rate for all units. Okay. So in this situation, then at Q1, our monopsonist buys at Q1, and this is the point at which marginal cost also equals marginal revenue. Okay. If they buy at an additional cost of that extra unit, that would then mean that that would be greater than the additional revenue, as marginal cost would be greater than the marginal revenue. And so at this point, we'd have a scenario where the output equates to a lower price being paid of P1. Okay, so that's the point at which the monopsonist is able to negotiate a lower price. So in this situation, the monopsonist basically has used their market power to reduce price and the level of output below what would exist in a perfectly competitive market. So that effectively is causing some form of market failure, in that we've said that in a perfectly competitive market, this would be our point of market equilibrium, and due to the buying power of the monopsonist, that has actually caused that to shift significantly, in both the quantity demanded and also the price paid will be significantly distorted by the monopsonist. So let's have a look at some of the costs and benefits of a monopsony then. So monopsonists can drive down price that it pays to suppliers. So one could argue that they are being productively efficient. If they can drive price and cost downwards, that's going to mean that their average cost curve is going to be significantly lower. Because the monopsonist is the sole buyer, its suppliers can either supply at the price set or they don't supply at all. So the monopsonist is pretty much saying to the supplier, we're the only game in town. This is the price that which we will pay. If you're not interested, then we're not going to buy from you. That's clearly going to there's going to be some benefits for the monopsonist, because it's going to lead to lower costs, as I just mentioned, and in some cases that might be passed on to the consumer in the form of lower prices. However, more often than not, it's probably going to be based on it's probably going to be kept by the monopsonist in order to generate higher profits. However, thinking about the implications for this of other members of this process, the suppliers will have to focus on cutting costs or be driven out of business, as they may in some cases not be able to cover their average variable cost if the monopsonist is basically demanding prices and selling prices to be significantly lower from suppliers. Then in that case that could be an issue, and clearly if suppliers come out of a market, there is an argument to say that that's then going to cause even greater market failure, as consumer choice may well fall. However, if the monopsonist is in a position where it's willing to take some of those savings and use them to some degree, that might actually lead to improvements in efficiency, both for the monopsony, because they might choose to use that extra profit that they've generated to improve innovation or costs of production or production efficiency. But it also might mean that in order for the supplier to be able to focus on cutting those costs, maybe they're going to have to look at significant improvements to efficiency, and one could argue that that would then improve the allocation of resources, and obviously if suppliers look to reduce their long run average cost, then you could argue that's also becoming both more productively and potentially allocatively more efficient. Okay, so let's take a look at natural or pure monopolies then. So we've looked at oligopoly, we've looked at monopsony. Now let's look at natural monopoly. Okay, so in this scenario is where if we've got a natural or a pure monopoly, we're going to see something known as continual returns to scale. So effectively, this will lead to an L-shaped long-run average cost curve, where average costs are always falling. Now, to some degree, one could argue as output increases, fixed costs are going to be spread over a larger number of items that are produced, and that clearly is going to then create the scenario where our long-run average cost curve is going to keep falling. Okay, now clearly that's going to give the firm in that situation an incentive to keep increasing the scale of production to reduce average costs further. It also means that where we've got this scenario where effectively we're talking about a firm and a business trying to achieve the maximum economies of scale, that clearly could then lead to significant barriers to entry in that market. Now, generally speaking, if we have a pure monopoly, or we're in a situation where it's considered to be in the public interest to just have one company providing that service, more often than not, the government will, to some degree, try to regulate that market, because as there's no competition, there's a danger that we're going to get lack of innovation. We could get price hikes and a whole range of other things. And one of the things that the government is very keen to do, particularly with things like where it's not in the public interest to have more than one supplier of a particular utility, for instance, then one of the issues that the government's very keen to make sure it doesn't happen is we don't get any customer exploitation within that industry. If it was left to its own devices, maybe if it wasn't being regulated, maybe they would exploit their strong market position. Okay, let's take a look then. So we've looked at that from one perspective. We're going to look at this in a slightly different perspective now. So we're going to look at how market failure might happen in labour markets. Okay, now effectively we've got two key components to this market, I suppose. One are trade unions, and we'll look at how trade unions might actually have an effect on, in some cases, market failure, but also we'll be taking a look at organisations that have a strong monopoly position in terms of the hiring of labour. Okay, so trade unions basically are in organisations that are designed to try to protect the interests of the employees that join them. Okay, now prior to trade unions, a lot of individual wage bargaining used to go on. So one employee would basically negotiate with their employer on their own behalf, and essentially it's not particularly efficient, takes a lot of time, and clearly causes all sorts of issues. So one of the reasons why trade unions were created was where the trade union basically said, well, we'll negotiate on behalf of our employees with the employer, and use various different things and different forms of industrial action should the members not get what they require from the employer. Okay, so to some degree it was designed as employee protection. Trade unions were very much about employee protection, and also they'll look at health and safety and making sure that again, employers are making sure that employees are safe in a certain scenario. So let's take a look at what might happen where we have a trade union in the labour market. Okay, so clearly trade unions are there to try to protect the interests of their members, and the power that they achieve is based on the number of people that they have signing up to join their union. If you can't get agreement, if there's discussions between the trade union and the employer and there is no agreement, then there are options for effectively the trade union to withdraw the goodwill and also ultimately the labour from that particular organisation. So there are a number of different levels. One, you can do what's known as a work to rule, where effectively the trade union will say, well, this is how we're going to work. We're just going to work to the agreed employment contracts, and we'll do nothing else. In some cases, they might actually encourage employees to go on a go slow, so work less efficiently, and clearly that is going to damage output for the organisation. Might also insist on an overtime ban. So again, if the organisation needs more more people to work, then in some cases the union might actually ban overtime. And ultimately, the ultimate sanction is to withdraw labour and actually go on strike. Obviously, that can cause a number of issues that can actually increase both long-term and short-term costs for a firm. And that clearly is then going to some degree, cause some form of market failure as a result. Let's take a look then at the way in which a trade union might affect a perfectly competitive market. And I'm just going to move my visog out the way a wee bit so it's slightly easier for you to see. So we've got a scenario here where, again, if we're in a perfectly competitive market, labour market, the equilibrium point is where D equals S. Okay, so that's our Q. So the quantity demanded at with our market in that's perfectly equitable is wage rate WR. Okay, and the quantity of labour is Q. Okay, so if a trade union operated, though, the argument would be they might be able to bargain a wage rate above the market equilibrium at WR1, wage rate 1. Okay, and you can see that effectively would then mean that that increase in the higher wage rate would therefore create a greater supply of labour. There would be more people willing to work at that level, and so effectively, not only would the wage rate increase, but also the number of people who would be willing to work would also increase. That essentially would create a new supply curve at S1, and supply of labour at S1, as you can see there. But in this situation, the demand for labour would fall because in this instance, we've got a situation where if it's more expensive to hire workers, then effectively our demand, which was at Q, is going to move to Q1. And that clearly, in that scenario, might well lead to excess supply of labour and higher levels of unemployment from Q to Q1. So less demand for labour causing an issue as far as that's concerned. Okay, now if we then take a look at the two, combining the two, and this is where it starts to get slightly more confusing, but if we just take it step by step, and again I'll move myself over here a minute so it's slightly easier for you to see. We've got a situation here where we've got a trade union and a monopsony labour market. Okay, so in this scenario, if we've got let's come out of that for a minute. If we've got a situation where a trade union exists in a monopsonist market, that can lead to higher wages and higher employment under certain conditions. Okay, so in this scenario then, if we assume that we have a perfectly competitive market for labour, that would operate at Q with a wage rate of WR. So if we had a perfectly competitive market, the quantity of labour demanded would be Q and the wage rate would be WR, like so. Okay, now when we're in a monopsony position, okay, the new equilibrium position, because in this case our monopsony labour market is essentially going to be driving that cost downward, the cost of wages downwards, we would have another point where at Q1, effectively, we would now be demanding quantity of labour at Q1, and the wage rate would be at wage rate 1, as you can see. Okay, so the monopsony market, or the monopsony labour market, the monopsonist in this case, the person that is the only supplier of, the only buyer of labour, would be attempting to lower the overall wage rate in order to reduce their labour costs. However, if we have a trade union that operates alongside this monopsonist or in this particular market, then we might see a shift in that the trade union clearly is attempting to generate higher levels of pay for its members. And in this scenario, we would have a different equilibrium position, in this case at Q2 and at wage rate 2. Okay, so you can see in this situation we would have a higher level of labour supplied, but also a higher price being charged for that particular good. That particular level of labour. Now, if we're in a situation where we've got a trade union working with a monopsonist, they might, as we mentioned, be able to secure or bargain a higher wage rate, and at that point we would actually get a new marginal cost curve would essentially be created, and that's going to follow. Sorry, I clicked on that. In this situation, that would follow the supply curve up to the point A, as you can see, but all the additional workers up to this point will be paid the same wage rate, okay? And after point A, it returns to its original position. However, if you want to attract more workers at that point, the firm would have to pay higher wages to all workers, which would mean that their marginal cost curve would become significantly steeper than the supply curve. And so the combination of the trade union with, in this case, a monopsony market is going to lead to a new equilibrium of Q2 and WR2. Okay, so effectively, you've got two competing scenarios here where you've got the monopsonist trying desperately to reduce its labour costs and trying to negotiate wage rates downwards, and trade unions trying to do the opposite, trying to get a fair day's work for a fair day's pay and trying to negotiate those levels upwards. So that clearly is going to cause distortion in the allocation of resources, and as a result of that could cause some market failure. So it's another example. What are the implications of market failure then? So we talked quite a lot about it and talked a lot about the different markets and the different imperfect markets that might cause this market failure. But what are the implications? Well, fundamentally, in most cases, market failure is going to impact on consumers as output will likely be lower and prices are likely to be higher than those that would be under the conditions of perfect competition. Excuse me. So in this situation, I suppose one could argue that the firms who are able to negotiate either cheaper prices or cheaper suppliers, they're going to benefit from higher prices. But effectively, they're going to benefit from higher profits, but consumers are going to lose some of their utility based on the fact that they are paying more for the good and service than they might have done if these firms hadn't actually used their market strength to actually put themselves in a better position. So the result is that effectively we're going to get both types of inefficiency. We're going to get allocative inefficiency because in that instance, remember, allocative efficiency is about attempting to provide consumers with the maximum utility at a sensible price, and productive inefficiency is essentially where businesses are trying to produce at the lowest average cost. So there's going to be a danger that this type of market failure is going to cause inefficiencies in both of those positions, and also some welfare loss in terms of consumers actually not getting the full maximum utility out of the market process that they're going through to either buy or a good or a service. Now, in some instances, governments will try to intervene in these markets, and in some cases they are successful. However, in some cases they are not, and that actually might lead to government failure, and that's something that we looked at in the previous slideshow that we went through. Okay. So there are some fairly significant implications for market failure, as you can see. There's a research task I'd like you to take a look at, and again, this is more for your own benefit in terms of just having information that you can use. So if you're going to talk about trade unions and some of the high-profile actions and cases that trade unions have been involved with, maybe look at one in the public sector and one in the private sector, and then consider, you don't need to write an article as such, but certainly supporting your research with diagrams and illustrating your points to be able to then apply this sort of knowledge to a range of different scenarios would be a really useful thing to do. So what have we looked at during this last presentation? We've really looked at market failure and the causes of market failure, which tend to be all related to market power, both in terms of buyers and sellers, but also in certain scenarios where if you've got a significant level of market power, do you then, or are you then in danger of not the free market not actually allocating resources in the most efficient way? We also looked at some of the implications of market failure on the business world and also for economic agents and governments. So thanks for listening. Obviously, later on in the week, we'll take a bit of time to go through a live lesson, and so if there's any stuff that you haven't understood based on what we talked about today, we'll have a chance to discuss that in the next live lesson, which I will arrange on Teams. So thanks for listening, and we'll catch up soon.